This is Create the Next from Pro CFO Partners, where every week we explore strategies and ideas for financial management and growth to help today's businesses put their financial picture in context.
Welcome back to Create the Next. I'm Chris Bentliff, and Randy Talcott is back with us. And Randy, looking forward to today's conversation because we're really talking about kind of financial adjustments, actions to take in the midst of financial uncertainty. And I love when we get to have episodes that are kind of with practical, tactical, actionable advice. And so everyone listening, sometimes I'll remind you, go get a pencil or open another browser window or something so you can make some notes because Randy, talk us through a little bit. What are high level? What are some of the things we should be thinking about? And what are some of the specific actions we should maybe be taking like this afternoon? What can we start doing right now to help us, I don't know, feel a little bit more in charge and in command in the midst of an uncertainty where we feel often so out of control?
Sure. Well, Chris, it's good to see you again. And just as a little bit of a backdrop, we're in some really uncertain economic times right now. Inflation's been high. The Fed has been increasing interest rates, and as a result, there have been a number of bank failures, and that's beginning to bleed through to other credit markets and so forth, and causing some tightening in the credit markets. And in situations like that, it can cause a bit of a downturn in the economy, which is something the Fed is expecting right now. So I think it's helpful for companies to be a little bit proactive in thinking about what they can do to sort of protect their current situation and protect themselves from some of these volatile situations that we're expecting in the future. I think the first thing that companies can do is really take a look at their sales projections and update them. So if you don't have a sales projection, I think now is a great time to be looking out for the current quarter, the next quarter, and really about 18 months ahead to see what do you think your sales are looking like over that period. Now, some people might say, well, geez, I'm not sure. Well, there's some things you can do, some practical things to help you assess that. And one of the things that you can do and should be doing is reaching out to your customers and asking your customers, well, what does the future look like to you? Are you seeing an uptick in your business? Are you seeing a slowdown? Are you seeing some flatness? And if they're seeing a downturn, you can ask them, well, what are you expecting? Are you expecting to be down 5%, 10%? What might it be? And depending on those conversations, you might want to revise your own sales projections because if your customers are slowing down, that's going to impact you as well. So update those sales projections and try to look out as far as you can in the next 12 to 18 months.
Talk to me a little bit about some of the leading indicators to that, because as you're sharing that, I'm thinking about others in my space that I work with, and one of the things that we marketing pros are looking at is basic web analytics. What's your, how year today versus a year ago versus 6 months ago versus 3 months ago? Are people visiting the website as much? Are they trialing, your product as much? Is the churn higher? We're looking at some things that will help us to say, well, eventually this is going to impact sales. Are there other metrics and sort of KPIs, those key performance indicators that you suggest we just we don't need to get crazy nerdy about it, but what are some of the things we can look at that will help inform some of that sales picture?
Well, sure. And I think, Chris, it depends a lot on what industry you're in. So in some industries where web traffic is really important, so in B2C industries and so forth, certainly web analytics are critical. In some other industries like manufacturing, they may be less critical because you're selling B2B, you're getting purchase orders from customers, you're not getting a lot of stuff from the web. So in circumstances like that, we look a lot at some of the reports that are coming out that the Fed produces or that other government agencies produce or even universities produce. Some things like uh, buyers' expectations for the coming quarters, consumer optimism. There's some, the producer price index, what's happening in there, what are we seeing? So you really have to, it's very industry specific, and you really have to look at the things that you normally do in the industry, but dive a little deeper into them to try to figure out what's really going on in there.
It's interesting, and just that level of like investigation can be consuming, and comprehensive. And so figuring out how to create the resources to allocate to that, I think is among the challenges that some of us are dealing with right now, is just sort of like, how do I read the tea leaves? So once I have a sense of my sales projections, and I love that you shared, look, if you haven't been doing that, now's a good time to start. How do I wrap that into a next step, or where do I go next with that?
Well, sure. The sales projections are the starting point, because that's really going to drive, excuse me, the rest of the business. So then what I like to do with my clients is put together a set of financial projections. And those projections will look out typically, I like to go out 2 or 3 years, knowing that it's going to be the near term that's the most accurate. And the longer, the 3 years from now is going to look a lot different than what you think it does today. So it's less accurate. But nonetheless, going through the exercise of putting those together is really informative. And it will give you a directional idea of what your financial situation is going to be looking like based on your sales projections in the coming quarters. So your projections should include income statements and balance sheets, which will, of course, include your cash balances. And that'll give you a good idea of what to do next. Whether you need to take certain actions or raise capital or whatever it might be.
I'm thinking about some of those organizations out there that are really, they've got leadership or a culture or a CFO in the mix, or whomever that is really, on point and detailed with. I was working with an organization once where a single change to a cell in Excel, he could say, look, if we sell whatever 5 less next month, look at what happens to the whole train. And it was really fascinating to be able to sort of see, wow, like these small things add up to great big things. What level of detail? And of course, it depends on all the different things. But if I don't have really robust, sort of detailed information like that, how do I stress test? How do I stress test my projections so that they're not just me throwing spaghetti against the wall, but there's something that I can really think about and take action on as time goes by?
Sure. Well, so one of the things that we like to do is we like to maintain financial projections on an ongoing basis, even when we're not in times of economic uncertainty. And the reason we do that is that it just informs us about what's going on in the business and allows us to keep looking forward. So things like your SG&A expenses, your rent, and your utilities and so forth, those are usually pretty much the same every month. So there isn't really a lot that you need to be doing in there on a monthly basis to update those. They don't change that frequently. Where you do see the changes is in your sales and your gross margins. So a change in sales is going to have some kind of an impact on gross margins. Now, I think it's a good idea to always be reviewing your gross margins on a historical basis. So when you produce your financial statements at the end of the month, look at your gross margin and ask yourself, why is it different from the month prior to that? So you start gaining a better understanding of it. That'll allow you to stress test your projections going forward, so that you can start with your average gross margin rate and say, well, if my sales drop a little bit, what's that going to do to my gross margin? It might cause it to drop fairly dramatically if you have a lot of very fixed costs in your structure. So we start with stress testing the financial the sales projections a little bit to say, well, what happens if sales drop 5%? What happens if they drop 10%? What happens if they drop 15%? And that's going to allow you to look at those different scenarios and try to think about what you might do to address those situations.
We talk a lot here at Pro CFO Partners about the value of your reporting being, as robust as it can be for whatever your situation is. And you're sharing a lot of reasons why just having that dashboard, that data, those numbers in front of you so that you can then take action, be responsive and not reactive, helps you to manage internally all the things that you need to do. But it's also a really important component when you're, looking for financing, when you're looking for funding, when you're working with your banking relationships. They also, and increasingly, let's talk a little bit about that. I think they're looking to have a lot of confidence in your business in order to have a business relationship with you. Is that how would you characterize that? And kind of what are some things we should be thinking about now as we get into the financing space?
Well, I think you're right. I think it's absolutely critical. So, yes, you should always be striving to get your historical financial information as accurate as possible. And you should always maintain some kind of a financial projection because, as I said before, it allows you to look into the future and try to be predictive and try to be proactive instead of reactive to situations. But just as importantly, if you have a loan facility, whether it's through a bank or a private equity firm or some other kind of facility, the one thing that I think is really important to remember is that lenders never ever like to be surprised at all. It's always a big negative if they're surprised. So one of the things that I like to do is meet with my lenders on a regular basis and give them my financial projections, give them my historical financial statements. And again, one of the values of doing financial projections is looking into the future. I like to do my covenant calculations right in the projections. So if you have an interest coverage ratio or a leverage ratio or something like that, I like to build it right into the projections so that I can see whether or not I'm going to be in compliance with my bank loan. And if I'm looking out in the future and I'm expecting a downturn and I'm expecting to violate one of those financial covenants, I want to talk to my banker about it right now. Because doing that will allow your banker to digest the information, begin talking to his credit committee, and most of the time, they're willing to waive a violation or to amend your facility in some way that will allow you to continue with the facility. Having said that, when you surprise them, that's when I see them putting, freezes on facilities, or if it's a really negative surprise, sometimes even calling the loan. So my advice is always get out ahead of that. Let your banker know what you're seeing a quarter to 4 quarters into the future so that they can work with you to develop some solutions for the company.
It's such good advice. And I love this. And Nelson and I talked. Nelson Tepfer is the CEO of Pro CFO Partners, and we've had as you're hearing this podcast, as you probably know, in the last 2 months ish, we've had some pretty dramatic things happen in banking, and the Fed stepped in, and the FDIC is all good, but there was a lot of sort of hand wringing and a lot of I got to get on the phone and talk to. And part of what I'm hearing you say is like, just have a real-time relationship with your banker and share in real time what you're going through. And I think the value of that goes beyond just sort of, the business relationship and into the, you are a part of the support infrastructure of how my business runs. And therefore we want to bring you into the way things are running. And sometimes, as you point out, if we don't look at our banking and our financing relationships that way, then we're at risk of jeopardizing our own support infrastructure. And I think it's important that relationship be cultivated frequently and often. Yes?
Yeah, that's absolutely true. So, oftentimes when you have a lending relationship, your banker will reach out to you on a quarterly basis to see how things are going. But there are times that I reach out to the banker instead when I'm the CFO of a company. So if I see something interesting, could be interesting good or could be interesting bad, in the company's future, I might just call them and say, hey, here's what's going on. Is there a time that we can sit down and talk? And it does a couple of things. First of all, you always have to remember that you're never going to meet with a credit officer at the bank. It's always going to be a loan officer. Mm-hmm. So you've got somebody at the bank behind the scenes making decisions about your credit. So the best thing that you can do is really educate your banker and make sure not only that they understand your company, your business, and your financials, but also that they find you credible. And being proactive, being honest with your banker, letting them know what you're seeing in the future, just builds your credibility with the bank, and it better educates your banker.
Randall Talcott is a pro CFO over here at Pro CFO Partners, and just so much good insight and advice. If any of this is making you scratch your head, jump over to procfopartners.com. Let's talk about it, because now is the time to sharpen some of the stuff up if it's dull for you. And if you haven't done any of it, now's the time to get started with that. Any other sort of the last piece of advice I want to leave you with today? Anything else, Randall, that we should make sure we keep in mind as we keep moving forward?
Yeah, I think if you update your financial projections and you're looking at a situation where you might need an increase in your lending facility or an increase in your equity on your balance sheet, now's the time to really begin thinking about that and in being proactive and trying to get some more funding. We're in very uncertain economic times now. And I think the more proactive you can be in doing all of those things, the better off you'll be.
Thank you, Randall. It's such good advice. The whole conversation today has just been really valuable. Appreciate your generosity with your expertise and your guidance, and looking forward to our next conversation together.
Great. Thank you very much, Chris.
Thanks for watching, and a special thanks to our subscribers. Consider becoming one today. Visit ProCFOPartners.com for more strategies and ideas for financial management and growth to help you put your business's financial picture in context.